Welcome back to Investing Talk Podcast.
Today we're looking at Intuitive Machines, the emerging leader in commercial lunar infrastructure.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of Intuitive Machines. When you look at the raw numbers, you really see a company that's moving from just an R&D venture into a true infrastructure platform.
It's basically a pure play bet on this whole emerging cislunar economy, right? But the big questions are, is that growth sustainable? And maybe more importantly, how long can they afford these losses?
Exactly. Let's start with the good news, because it is really good news. The revenue trajectory.
Okay, let's unpack this. The growth rate is, well, it's nothing short of explosive.
It is. We are talking about revenue going from about $79.5 million in 2023 to $228 million in 2024.
That's a 187% year-over-year jump. I mean, that's almost unheard of. It really shows their services are gaining massive traction, especially with NASA.
Right, and they've kept up that pace. For just the first 9 months of 2025, they reported $169 million. So they've clearly crossed a threshold. But that huge growth figure, it kind of masks the financial reality.
The profitability challenge.
That's the one.
Okay.
It's the caveat that stops investors in their tracks. That 2024 full-year GAAP net loss of $346.9 million.
Yeah, on paper, that looks catastrophic. We really need to explain why that massive loss isn't quite as terrifying as it sounds.
This is such a critical point for these high-growth, newly public tech companies. That loss figure, it's loaded with non-cash noise. The biggest piece was a $120.1 million change in the fair value of earnout liabilities.
Okay, stop right there. For our listeners, what does that actually mean, fair value of earnout liabilities, and why should we basically ignore it when judging their operational health?
It's essentially an accounting number. It's a liability on the books for potential future payments to owners of companies they acquired. If the stock price goes up, the value of that future liability goes up. It's an accounting entry, not cash going out the door for running missions.
So it tells you nothing about their ability to build and launch things efficiently.
Exactly. So if you strip away all that accounting noise, what's the real operational picture?
What does it look like?
The operating loss in 2024 was closer to $57.4 million. Still negative, yes, but the underlying health is showing signs of just radical improvement. And the real proof is in the gross margins.
This is where it gets really interesting for the business model.
Yeah.
So tell us about that margin turnaround.
They went from deeply negative, negative 26.3% in 2023, to positive 16.5% in 2024.
That's a 42 percentage point swing. That is a textbook example of operational leverage kicking in.
It is. As they do more missions, their fixed cost mission control engineering teams get spread across a much bigger revenue base. It's the difference between building one super expensive lander and then using that same infrastructure to build 3 or 4.
The efficiency just skyrockets.
Absolutely. And that allowed them to briefly hit a small net income. I think it was just under $1 million in the first quarter of 2025. That was a huge proof of concept. It shows they can be profitable at this scale.
Okay, so that margin turnaround is the key indicator. But the losses are still there, which leads us straight to the balance sheet. They've built up what looks like a fortress of liquidity.
They have. This massive cash hoard just completely de-risks the short to medium term. As of September 30, 2025, the company has $622 million in cash.
$622 million. That's an increase of over $414 million in just 9 months. So where did that capital infusion come from?
It was a pretty sophisticated strategy. Earlier in the year, they did some equity offerings, warrant exercises, that brought in over $410 million. But the real anchor was the convertible notes they issued in August 2025.
Tell us about that note, because the terms seem incredibly favorable for the company.
Stunningly favorable. They raised $335.5 million net. It carries a tiny 2.5% coupon rate, and here's the kicker, it doesn't mature until 2030.
Wow. So in this interest rate environment, securing that much capital for 5 years at 2.5% is an incredible win.
It means they have cheap capital, and they won't need to tap the equity markets and dilute shareholders for years. It buys them time.
And they need that time, because their competitive edge, their moat, is all about expensive, high-stakes execution.
Exactly. And their primary moat is their proven flight heritage. They are the only commercial company to have successfully landed and operated a spacecraft on the moon. They did that with the IM-2 mission in March 2025.
And that's not just bragging rights. I mean, that success translates directly into contract security. Their competitors are still chasing that milestone. Intuitive Machines already has it.
Absolutely. And it goes beyond the landers. They have exclusive sole source contracts with NASA for specific direct-to-Earth communication services. Think of it like they own the data link back to Earth for certain operations.
That locks in long-term revenue.
Yeah.
Okay, that brings us to their vertical integration. I remember a recent acquisition that really rounded out their capabilities.
That would be KinetX, which they bought in October 2025 for about $30 million. KinetX brings over 30 years of deep space navigation expertise, so now they control the whole stack.
The whole cislunar stack. So the physical hardware with the landers, the data transmission with network contracts, and now the critical navigation to get there.
Right. It creates huge switching costs for any future customers. They're a one-stop shop for lunar logistics. So the bull case is pretty clear.
Yeah.
Triple-digit growth, improving margins, a huge cash cushion, and a real technical moat.
It looks incredibly strong.
Yeah.
But the market is clearly pricing in significant risk. So let's talk about the bear case. The primary concern is always execution.
It's the biggest overhang, absolutely. And we have to address the elephant in the room. What happened with both the IM-1 and IM-2 missions?
They both tipped over. They reached the moon, which is incredible, but they landed on their sides. Now, IM-2 still completed its main objectives, but the visual, it hurts confidence. Another failure could be devastating.
The market is waiting for them to prove not just that they can land, but that they can land consistently and, upright. So what are they doing to fix that for IM-3?
Well, they've implemented hardware and software upgrades, stronger landing legs, better descent algorithms, but the interesting part is their strategic choice of destination for this next mission.
Right, they're not just relying on hardware improvements, they're also playing the odds.
Exactly. The IM-3 mission is targeting a site called LUNR Gamma, which the company itself describes as significantly easier terrain than the South Pole site of IM-2. It's a smart move to reduce risk right now.
But it does raise a question. Is that a sustainable long-term solution or just a short-term fix to appease the market? The real money is in landing in the tough places.
That's the challenge. The second major risk is typical for these kinds of companies, customer concentration.
And their exposure is intense. As of June 2025, NASA was something like 64% of their accounts receivable.
So if NASA's budget changes or a new administration shifts policy, Intuitive Machines is heavily exposed, especially on those fixed-price CLPS contracts.
Right, the commercial lunar payload services contracts. NASA pays a fixed price. If the company's costs go over, that's their problem. So how are they trying to diversify away from just being a NASA taxi?
Their strategy seems to be shifting from just missions to being an infrastructure provider. Monetizing that data transmission network, offering infrastructure as a service, and actively going after commercial customers, not just government payloads.
Moving from a space taxi to a space utility company.
Exactly. So for listeners looking at the timeline, what are the biggest near-term catalysts we need to watch?
The primary one, the one everyone is watching, is the IM-3 mission launch. It's slated for December 2025. And it's pretty binary.
A successful upright landing changes everything.
It validates their upgrades, proves consistency, and it just de-risks the entire execution thesis. Failure would be a major setback.
And on the financial side, when's the next big data drop?
Full year 2025 earnings in February 2026 will be critical. Analysts will want to see revenue comfortably above $250 million, but more importantly, an inflection point in that negative operating cash flow. They need to see the cash burn slowing down.
Looking at the stock, it's been in a wide range, between about $750 and $1450 over the last 6 months. What's the technical picture telling us?
We've seen some pretty strong accumulation. After a dip in early December, it rebounded sharply, which tells you there are buyers waiting at the low end of that range. It's also trading above its 50-day moving average, which is a near-term bullish signal.
So for a potential investor, how do you think about an entry point here? Are you buying the uncertainty before the mission?
For a long-term holder, a pullback towards that $9.50 to $10 range might offer a better risk-reward entry before the IM-3 results. You're buying the fear. For a short-term trader, a successful December mission could easily drive a sharp breakout above that $14 resistance.
So the core thesis here is that Intuitive Machines is really the pick-and-shovel play for the new lunar economy. They have the cash, the contracts, and the first-mover advantage.
Exactly. They've achieved what no one else has, and they've funded themselves cheaply until 2030. At the end of the day, the investment thesis now hinges completely on consistent, successful execution of IM3 and then scaling those infrastructure contracts over the next year or two.
It's a fascinating mix of high-risk space exploration and stable government contracts. We'll be watching that December mission very closely. Make sure you're subscribed to the Investing Talk podcast to catch our update when that news hits.